Hello everyone. In this presentation, we will see bear spread. It is an option trading strategy used by the option traders when they expect the fall in the market. Bear spread can be created either by using put option or by using call option. So here we will see how to create a bear spread with the help of figure, its payoff table and a numerical on it. So let's find it out. To start with bear spread strategy, first of all, let us understand what happens to the market, which helps the option trader to make a bear spread. Here you can see that the bear has overpowered the bull. The bear has become powerful. There is a strong pessimism in the market, and that lead to a sharp fall in the market with a red candles follow up by red candles and then followed by red candles, and this fall in the market is called a bearish market, which helps the option trader to create and earn money from the bear spread. No doubt the bearish move of the market creates a huge panic among the investors. However, this fall in the market when it is in a bearish mode does not mean that investor cannot earn. Our bear is very smart. This bear spread provides the opportunity to the investor to earn money in the option market by creating a spread which is famous as bear spread. An investor who enters into a bear spread hopes that the stock price would decrease and earn money by creating an option trading strategy famous as bear spread. Before making a bear spread, we should keep some important points in our mind. Point number one, bear spread is a normal spread. That is, it is created either by using a put options or by using a call options. It is not a combination spread. So, we should not use both call and put together for creating a same option strategy. Point number two, like bull spread, bear spread is also a vertical spread. It is created when there is a vertical move in the market. The market falls down vertically and that gives opportunity to create a bear spread. Point number three, bear spread is created when the market takes a directional move. That is a move of downturn when the market fell down, and that leads to the opportunity for the bears to earn from the market. Now the question is, what is the directional move of the market that gives the opportunity for creating a bear spread? So let's find out this directional move from the coming slides. Now let us understand this directional move with the help of the candlestick chart. This is the monthly chart of Nifty and each candle is showing a monthly candle. So these are the small candles, and after this market took a directional move. It fell down vertically. This is the green candle which appeared at the spread of COVID worldwide. COVID news came in India in January 2020. In February, restrictions were started, and in March, the Prime Minister announced the lockdown on 24th March for 21 days lockdown, and that created a panic and witnessed a huge fall of the market. If we see this monthly chart into a weekly chart, we will find a more beautiful downturn move with this red candles. This shows a bearish move in the market where investor lost the confidence in the market and market became panic. Here we can see a weekly chart of Zydus Life, and this is also showing a weekly chart, a bearish move in the market. A market is falling down. Another chart, a weekly chart of Infosys, where we can see a sharp fall of the market with a gap. Now let us see one daily chart of Manappuram Finance. Here we can see the market has taken a downturn move. Each candle is a daily candle, which shows that after a base of few days, market fell down. So from these charts of monthly, daily, weekly, and hourly, we can see that the fall in the prices leads to the bearish move of the market. Market changed its direction and fell down, and this gives the opportunity for the option traders to create a bearish spread. So in bearish spread, option trader can make money depending upon their trading style, whether they are a monthly income trader, swing trader, daily trader, or hourly trader. So now it is pretty clear that bearish spread is a spread which is created when we expect the fall in the market. This spread can be created either by using a put option or by using a call option. So let's find out the bearish spread using put option. Now the question that comes here is, what is put option? Put option means right to sell the underlying asset. When you will sell the underlying asset, you will sell it only at a higher strike price to earn maximum profit. So this is a weekly chart of Nifty. Here we can see that at 12,200 level strike, we can sell the Nifty. That means we can take a long position, long put. So getting a right to sell Nifty at a strike of 12,200, we have to pay option premium. So by paying the option premium, we get the right to sell the Nifty at a strike of 12,200 level. Now we will wait the market to fall down and we again buy at 7,800 level. So this shows that selling was done at a higher strike of 12,200 rupees. Buying was done at a strike of 7,800 rupees, the lower strike, and the profit is 4,400 rupees in the put option. So in put option, when you are taking a long put position, your opposite party will take a short put position. Long put position means buying a right to sell the underlying at a high price. How you buy this right? By paying the option premium or option price. So you pay this option premium to a short put holder. He is selling a right to the long put holder by receiving the option premium or option price. Another important point which we have to keep in mind when creating a bearish spread using put option, that it requires initial investment because the strike price at which put option is purchased is K2, the higher strike, and the strike price at which put option is sold is K1. So buying price is greater than the selling price, and the profit positions are calculated on the basis of the position of stock price at the time of expiration. So this can be easily seen from here that since the buying price is higher than the selling price, that leads to the initial cash outflow because the price of put sold is less than the price of put purchased. Let us create a bear spread using a put option. This is the profit and loss line, and this the stock price moving from 0 to higher level at a time of expiry. We have two strikes K1 and K2. We take a long position, the long put. That means we are buying a right to sell the underlying at a higher strike of K2 by paying the option premium. Now what is our expectation? That after selling, the stock price at the time of expiry falls down, and that would give unlimited profit to the long put holder. But what happens if the market goes up against the expectation of long put holder? To ensure the portfolio profit, we take one short put position. We short a put at a lower strike of K1. So that means you are selling at a low price and buying at a high price. That requires initial cash outflow when you create a strategy. Now, if the market, instead of falling down, goes up, your long put will be having a limited loss and long put will expire worthless. Well, your short put will earn profit for you, and that profit will be a profit which is limited to your option price. So this shows that your final payoff will be in form of a Z line, which shows the total profit from the bear spread using put option. Let us see the payoff from the bear spread created using put option. So here we are seeing the stock price range with three probabilities at the time of expiration. This is the payoff from long put option, payoff from the short put option, and the total payoff from long put and short put. So first we're taking probability that the stock price fell down and it's lower than the K1. So this shows that long put will earn huge profit, that is equal to K2 minus ST. Short put will have this much of payoff and total payoff will be K2 minus K1. If the stock price is in between two strikes, long put is still in profit. The payoff is this, short put payoff is 0. The total payoff is K2 minus ST. If the stock price is beyond the higher strike, your long put will expire worthless. Payoff from short put is 0, total payoff is 0. So this shows that if the stock price are higher, total payoff is 0. But as the stock price goes down, the payoff increases. So we move from 3 to 2 to 2 to 1. Our payoff goes on increasing. So this is the total profit line, which shows that like bull spread, bear spread also limit both the upside profit potential and a downside risk. Let us see a numerical question on bear spread. So I suggest all of you to plot the question on the figure for easy understanding. So the question says an investor buys a 3 rupee 3-month European put with a strike price of 35 and sell for 1 rupee 3 months European put with a strike price of 30. So the expiry period is same 3 months for both long and short put. Now you are buying a long put for 3 rupees, so you pay 3 rupee and you are receiving 1 rupee for shorting a put at rupees 30. Now the payoff from the bear spread strategy is 0 if the stock price is above 35 and 5 if the stock price is below 30. If the stock price is in between 30 and 35, the payoff will be 35 minus ST. Now first we will find out what is the cost of making this strategy. So the cost is the amount what you have paid for creating a long put and the amount what we have received for short put. So the total cost is minus 2. This shows that there is initial cash outflow when creating strategy using bear spread. Now let us see the total payoff table, which shows the probability of the stock price range and the effect on the total payoff. So first probability we are taking that the stock price is lower than the K1, the lower strike. So this shows when the stock price is less than 30, total payoff will be 5 rupees. So 5 rupees minus option cost, that is 3 rupees total profit. If the stock price moves between 30 to 35, the payoff is 35 minus ST, from which we deduct the option cost, and the payoff will be 33 minus ST. Whatever you get more than the stock price at expiration. Now if the stock price moves beyond higher strike 35, so your option expire worthless and your loss will be equal to the option cost, that is 2 rupees. Till now we have seen how bear spread is created by using a put option. Now we will see how to create a bear spread using call options. Call option when used to create a bear spread, requires the investor to buy a European call at a higher strike of K2. Along with that, he sells a European call with a lower strike of K1. So both buying and selling is done on a European call on a same stock and at the same expiry. The important point which you all remember here is when you create a bear spread using call, it involves initial cash inflow, unlike the bear spread used for creating a put where there was an initial cash outflow. Now we will see how call options is used to create a bear spread strategy with the help of this figure. This is the profit and loss axis and this is the stock price line moving from lower level to higher level at the time of expiry. We have two strikes, the lower strike K1, higher strike K2. Now first we will buy a call. We will take a long call at a strike of K2, higher strike, in the expectation that the stock price at the time of expiry will go up and long call will have unlimited profit. But what happens if your expectation goes wrong and market takes a bearish turn? The fall in the stock price at the time of expiration gives you a loss. Your long call will expire worthless and gives you a limited loss. This loss is limited to the option price what you have paid to buy a long call. Now, in order to minimize your loss, you take another position that is short a call. You short a call at a lower strike of K1. That means if the market goes down, your long call will expire worthless, giving you a limited loss equal to the option price, but your short call will earn for you. Short call will give you a limited profit. That limited profit is equal to the option price what short holder has received in getting a right to sell a call. So that shows the total payoff, which is the line in a red color showing the total payoff from the call option for creating a bear spread. Now the important point here is you see here that bear spread limit both upside profit potential and downside risk. So in this figure we can see that creating a bear spread, our upside profit potential is limited to the option price what short call has received, and the downside risk is limited, which is equal to the option price what long call has paid. Now let us see both the put and call for creating a bear spread on a same slide and let's compare. So here we can see that in put there is an initial cash outflow and in call there is initial cash inflow. However, the total payoff or the shape of a total profit line is same for both call and put strategy for forming a bear spread. Now before concluding, if we see the charts again what I have introduced in the beginning to show the direction. Now on this chart I will plot a total payoff line from the bear spread. So here the total payoff line shows that bears are selling the underlying at a high price and buying at a low price and earning the profit from the bearish move of the market. So in this final slide, I have taken a weekly chart of Nestle and I'm trying to show you the change in the direction and how the option trader earned profit from creating the strategy. So when the markets are falling, option trader makes a strategy called bear spread where they sell at a high price and buy at a low price and earn profit from bear spread. Now when the market has changed its direction, it's moving up, option trader can make a strategy called bull spread where they can buy at a low price and sell at a high price and earn the profit. So now my question to all of you is, this final figure is showing some combination spread. Answer what is this combination spread showing in the chat box given below. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.